We are Group 3 and will be presenting financial statement projection for Celcom Berhad. This slide presenting our team members. So let's look at our problematic ratios. We found that Celcom Berhad is currently facing several financial issues based on its financial ratios. For liquidity ratios, both the current and credit ratios are declining, indicating a potential liquidity risk. The current ratio has dropped to a critical level 0.0045 per 1 in 2023, largely due to reduced cash and short-term deposits, which have been allocated for dividends, acquisitions, and operational expense. For profitability ratios, there has been a significant decrease in return on asset ROA and return on equity ROE since 2022. This is primarily due to substantial increase in assets and equity post-merge, while revenue and profit levels have not shown significant improvement. Essentially, profitability has declined without a corresponding rise in revenue. For asset management ratios, the total assets and fixed asset turnover ratios have also decreased significantly. This reflects inefficiency in generating revenue from the increased assets base after the merge, as revenue has not increased proportionally with assets growth. For market ratios, the price to earning PE ratios is risen, driven by lower earning per share EPS in 2022 compared to 2021. The highest PE ratio suggests that the company's shares are more expensive, which may deter investors looking for undervalued stocks. In summary, Celcom is struggling with liquidity risks, declining profitability, inefficiency asset management, and an unattractive market position. And this problem will be solved in the part of pro forma statement.
Good day, doctor. My name is Yotibun, metric number 291821. Now I will present the pro forma statement. First, we find the parameter of financial statements by using historical data. Since Telkom Digi merged in 2022, so we used average data of balance sheet from 2022 to 2023 and average data of income statement from 2018 to 2023 to find the parameter and use the parameter to forecast income statements and balance sheets. As a result, this will make our projection in pro forma statement to be more accurate. After that, we forecast by setting up several assumptions, which are total asset equal to total liability and equity, debt to equity ratio less than 0.6, and we assume Celcom DG maintains a portion liquidity level where maximum cash of 6,000 ringgit and minimum cash of 5,000 ringgit. Then we use solver to find the maximum SGR and use cash as plug. It will make the company generate the highest possibility of profit without external equity financings for the following years as revenue grow with SGR. We found that deficits in free cash flow put firm at risk of liquidity. The cost of deficits in free cash flow is substantial purchase of non-current assets. The non-current assets in 2025 and 2026 are forecast to decrease because we liquidate a portion of non-current assets to obtain cash for cover the high debt in 2024 forecast. To sum up, our forecast has shown Celcom Digi have improved in terms of liquidity, profitability, and a slight improvement in asset utilization efficiency and steady market expectation.
Hi, good day. My name is Liu Gao, and for this part, I will talk about the problematic financial ratios based on our pro forma statement. For the first financial ratio is liquidity ratios. The current ratios. Celcom Digi have serious liquidity risk at first. After we assume and project Celcom Digi will maintain a minimum and maximum cash of 5 million and 6 million, then we see an improvement of current ratios to 0.3285 per 1. However, this number is still indicate that the Celcom Digi have liquidity risk to consider. In terms of the profitability, ratios both ROA and ROE have been declined and become 7.46% and 5.06% at the end of our projected period in 2028. However, the return has become stable. As a result, we say CelcomDigi is able to maintain a good returns. Okay, for the next part is the efficiency ratios. We look at the total asset turnover and total fixed asset turnover that shows improvement to 0.0693 and 0.0694 respectively. This is because in the pro forma statement, we adjust CelcomDigi will liquidate some of the non-current assets in 2025. Hence, CelcomDigi have improved on efficiency to generate revenue using fixed asset and total asset. Moreover, for the PE ratios, CelcomDigi is able to maintain around 29.91, which is good. On the other hand, the earning per share at the 2028 is 0.10 is 10 cents, okay, which has been declined compared to 2023. However, we can see the trend of earning per share is quite stable, therefore, CelcomDigi is able to generate stable return for the shareholder. Thank you.
Greetings to Doctor, I'm in graph entry number 292218. Now, I would like to continue the comparison part. The historical Amman-Jack score from 2021 to 2023 reflects strong financial health, with a significant outlier in 2021 due to an extremely high value, followed by normalization in 2022 and 2023 at a still healthy levels. In contrast, the projected Alma-J score revealed a short-term dip in 2024, entering the grey zone with a score of 2.76, which indicates moderate financial risk. However, the score improved steadily from 2025 onwards, exiting 3 and maintaining financial health through 2028. While historical data show consistent financial stability, the projection highlights a temporary risk period followed by recovery, suggesting the need for proactive management in the short term to sustain long-term financial health. Moreover, in 2021 to 2023, the historical free cash flow fluctuated significantly, with a sharp negative dip in 2022 because of the merging between Celcom and Digi.com Berhad, followed by a recovery in 2023 as profit after tax increased. In contrast, the 2024 to 2028 projection show a more structured recovery, starting with a negative free cash flow in 2024, but turning positive in 2025 and remaining stable in subsequent years, despite declined profits. While both periods face capital expenditures, the 2024 to 2028 period suggests a more predictable cash flow recovery, with controlled increases in current assets liability, compared to the volatility seen in 2021 to 2023.
Hello, Doctor. This is Wong Wai Ho. I'll be doing the conclusion for the report. After the merger, the company experienced several unstable situations financially, which is the decline of net profit and the increment of the liabilities. The changes happened to downgrade the company's financial performance based on the calculation of the financial ratio in Chapter 2. But there are some of the benefits and also advantages of the company, which is CelcomDigi. The first one is the good performance during the rapid growth of the telecommunication and ICT sectors. The second one is industry advantage, which is the changes to 5G generation will lead the whole telecommunication sector to become one of the largest and most important sectors in the country. And number three, the financial healthy, which is they maintain the financial health and the results in healthy score, in optimum ZIG score, which are above 3. Lastly, the pro forma result that we run in the Excel, we calculate that the company's financial performance will return to stable growth after 2024, and the dividend to the investor will increase while the retained earning also increase as well. So as a short conclusion for this analysis report, despite the risk and uncertainty in the company and faced by the company and also the peers in the same industry, CelcomDigi will be a valuable and profit strengthened investment for the investors. So we estimated the future stock price of the CelcomDigi will be RM 3.19 per share in 2024, and the growth of the stock price will become RM 3.2 per share for the rest of the projection period from 2025 to 2028. And that's all from me. Thank you.